Hey, my name is Ben, and if you're new to the channel, let me get you up to speed. A while ago, I made a review about a home improvement that I made. I installed Tesla solar panels and a Powerwall, and I paid for it with a cash-out refinance, which is something I'll talk about in this video, but when I did it, I got so excited that in my review, I said, cash-out refinance made the system free, basically. And that remark was the topic of several comments and questions. Some people applauded me for finding an excellent way to pay off my solar panels, and some people criticized me saying that I should never give financial advice because I clearly didn't know what I was talking about. Well, which is it? Like, did I just get excited and say something that was totally false? Or did I actually, know what I was talking about? I really want to know, and I want to give reliable information to these people who ask these questions. So that's what we're going to talk about in this video. We're going to talk about what a cash out refinance is, why I think I'm at an advantage because of it, and what that could possibly mean for you. I've got all of the information here, and our attention is going to be down at these two cells. If these numbers are green, then I will be vindicated, and I'll be making a video about how you can do the same. And if these numbers are red, then the critics were right, and I will be making a video about how not to make the same mistake that I made. So, let's see what happens. Ooh.
Like a Hellcat.
So before we get started, let me talk about two different camps. These are two authors who have very different ways of interpreting and dealing with debt. On one corner, we have Robert Kiyosaki, and on the other, Dave Ramsey. Now, Dave Ramsey is all about eliminating debt and making decisions and playing strategies that will help you pay off debt quickly. Robert Kiyosaki, on the other hand, is all about using debt in a smart way, using good debt as opposed to bad debt. Now, as you're about to find out, I fall more into Robert Kiyosaki's camp than Dave Ramsey's camp. However, I will say that one of the things that's nice about Dave Ramsey is his idea is compatible with the entire world. Like, if everybody just did what Dave Ramsey says, the whole world would be a happier place. However, not everyone does what Dave Ramsey says, and Robert Kiyosaki depends on it. Robert Kiyosaki's advice is about becoming rich by taking risks and assuming debt while other people are dealing with debt irresponsibly.
Yeah.
And what's the interest rate?
Right now it's at some 5%.
Oh, whoop-de-doopty. Just pay it off, dude.
Well, some financial experts are saying get out of debt. I'm saying learn how to use debt.
These two guys are very different, but there's probably nothing they disagree with more than how to handle a cash-out refinance. So let's talk about what a cash-out refinance is. First, a ordinary refinance, right? An ordinary refinance is when you buy a home from yourself using a better loan than your previous loan. You basically pay off the outstanding balance on your old loan, and therefore you assume the house under the terms of a new loan with usually a better rate. In situations where you've paid off a large portion of the balance of your home, or the market has inflated the value of your home, or you've done renovations to improve the value of your home, you can do a refinance and pay off more than the outstanding balance on the loan. That extra money, since you're buying from yourself, gets put in your own pocket. It's money that you're borrowing from the bank at the rate of a mortgage loan. So what's really happening is you're trading in equity on your home for a good rate on a long-term loan. I first learned about a cash-out refinance to pay for home improvements when I read a book about house hacking. And if you're interested to hear more about house hacking, you can check out that video. So is a cash-out refinance a good idea? Well, in order to answer this question, I'm going to have to look at a lot of numbers. And I did a little bit of research on YouTube just to see what else is out there. The numbers are like a little bit of a turnoff. So before I get into like the spreadsheets, let me just explain this using some pictures. How does that sound? I want you to imagine a situation, and to keep things like easy to envision, instead of using homes and loans and like APRs and things, we're just going to talk about businesses. So imagine I have two businesses, a restaurant and a laundromat. I'm going to represent how these two businesses are performing using bar graphs, and the revenue, the money that I'm bringing in, is going to be this blue bar, and the expenses I'm going to represent in this red bar. Now, normally you'll see the red bar is below the x-axis, but in order to see the relative value of the two bars, I'm going to put the red bar next to the blue bar, and then if the red bar is smaller than the blue bar, then I'll be left with a little bit of extra, which I'll color in purple, and that's going to represent profit. So my revenue minus my expenses is my profit. Okay? Now, like I said, the laundromat does better than the restaurant. So if I was to compare the two, it might look something like this. Now, suppose in this situation, I'd like my restaurant to do better. So I decide I'm going to try a food truck, and I hire another chef to work at the food truck, and I get the business started. And after a while, it looks like the food truck wasn't a very good idea. What could I do from there? Well, I could probably do a few things, but in this situation, let's just imagine that I decide to sell the food truck, to just discontinue that service entirely, but rather than fire that chef, I just hire him over at the restaurant. All right, and what do I do with the money from the truck? Well, I take that money and maybe I buy some more machines for my laundromat. Okay. Is that a good decision? I mean, it's a really open-ended question. Is it a good decision to sell a food truck and to hire the chef and use the money from the truck to invest in the laundromat? Well, it kind of depends on a lot of things. There are so many factors that I haven't even talked about. Like, what is the chef being paid, and what's going to be the retention rate of the customers that he brings over? And is adding more machines to the laundromat actually going to lead to an increase in revenue? And most importantly, what does this have to do with a cash-out refinance? Let's talk about that. In this scenario, it's pretty easy to see that the businesses are all assets. They all make me money. They have the little purple bar. Well, similarly, in my situation, my business, my home, my solar panels, they're all assets. At least I claim that they are assets, and I'm going to have to talk a little bit more in depth. If you're a big fan of Robert Kiyosaki, you're going to say, hey, a home is not an asset. Robert Kiyosaki doesn't say so. Well, again, if you're house hacking, then that means you have a house with multiple units and you're renting part of your house in order to bring in income. So a house can actually be an asset. Anyway, so before I had solar panels, I had a home and I had a business and investments. And then I decided to add solar panels, which became that third business. The solar panels are the food truck. And then eventually I decided to absorb the expenses from the food truck into the restaurant and take the excess money, if there is any, and put it into my laundromat or my business and my investments. That's the parallel. It's going to depend on how much money I'm saving with my lower interest rate, and it's really going to depend on how much money I'm making by buying more machines at the laundromat or in my investments. Let's take a look at the numbers now. In this spreadsheet, we're comparing different outcomes based on refinancing to cover the costs of an improvement like solar panels and a Powerwall. So up at the top, I have my original mortgage, which if $608,000 is like a stupid large number for you, I agree with you. It's San Diego. The real estate there is ridiculous, but it is what it is. This was my original APR. And so I've used a formula here from a loan cost calculator, but it tells me what the total loans cost is, which is a calculation for if you add up all of the payments and the interest that you pay for the lifetime of the loan, how much does the loan cost you after your 360 or 30 years of loan payments? And then this is my monthly cost for the loan. Of course, that excludes taxes and insurance. Down below, we're comparing the original loan to two different refinancing situations. One is if I just simply refinance. I don't do a cash out refinance and pay for the solar array. I just buy the house for myself. The other situation is if I do a cash out refinance to pay for the solar array. Now, the reason this number is only $600,000 instead of $608,000 is because in my situation, we had already paid that much principal off the original loan. So we had more equity in the home than we had before. The amount down here, by the way, is the same as above, but adding in the cost of the solar loan and subtracting the amount that we paid from our tax refund. So the way that the timeline worked in our case was we bought a house, we installed solar panels, we got a tax refund, so that was money back in our pockets, and then we refinanced. But since we already had that money back from the tax refund, we didn't need to include that when we were absorbing the cost of the solar loan. Now, earlier in this video, I said that a refinance can save you tens of thousands of dollars. If you just look at the first two rows here, $1,171,000 versus $1,029,000, we're saving almost $150,000 by refinancing with 3.625% interest. Now, we're going to jump down to the bottom, which is actually a little bit more complicated. This is the solar loan. And the way the solar loan worked is not like a home mortgage. So the solar loan was for 20 years, which makes sense because that's how long the solar panels were guaranteed for. And there was a condition on the loan. We had what we called a target payment. So the target payment was $191 a month. And the amount of that target payment is not arbitrary. They're choosing a target payment because that's how much money we would have spent on our electric bills every month. Okay, so in order to keep that target payment, there's a condition that we take the tax refund and pay down the principal balance. $191 a month is not sufficient to pay off the entire cost of the loan. So after we pay off that principal balance with a $11,000 tax refund, then we pay $191 a month for the rest of the loan's lifetime. So because of that situation, I created this pane over here, which shows the principal balance over the course of time. And if you jump down to payment 18, I think it is. No, payment 16. So 16 payments of $191, and then there's a big jump from $39,000 to $27,000. That's because at payment 16, that's when the tax refund pays down the principal. And then based on that target payment for the rest of the period, it takes 234 payment periods to pay off the solar loan. And so that's reflected right here. Okay, so with all of that information, in order to complete this spreadsheet, what I need to do is populate this cell with the total loan cost, including solar panels, and then that'll automatically populate this monthly payment, which those two numbers will be copied down here, and then I'll get the numbers that go right here. The amount saved on the total loan cost by including my solar panels, and the amount I save monthly. But here's the thing. This monthly amount is going to be the amount that I save monthly today. Keep in mind that the number of payments on the solar loan is less than the number of payments on the mortgage. So if I had kept the solar loan originally, then after 234 payments, there would be no more payments. The loan would be paid off, and the monthly payment would be zero. So for now, though, this is going to be the amount saved every month, including panels, when I eliminate my $191 payment. So this is the moment that we're going to find out what this video is about. Let's see what happens. Okay, so let's talk about these results. First, the amount I saved by including panels. I'm not saving money. I'm losing $978. However, I'm saving monthly $64. how does that make any sense at all? How could I be saving money every month but losing money over the course of the loan's lifetime? Well, that has to do with these numbers over here. Remember how I said that 234 is the number of payments that I'll have to make on the existing solar loan before it's entirely paid off? 234 is less than the 360 payments that I'm making towards my mortgage. So that means for 234 consecutive months, I'm going to be saving $64 a month. Altogether, that's like $14,000. However, after that, there's still 126 payments that I'll be paying towards my larger mortgage that I wouldn't have had to pay anything had I kept my solar loan separate. So this negative $978 means that over the entire lifetime of the mortgage, at the very end, the extra money that I'm paying, because I've stretched out the duration of the original loan, is going to exceed the amount that I saved for the first 234 payments by $978. So the later part is more expensive than the earlier part. That's what that means. So, did I make a mistake? Well, here's the thing. Remember how I said earlier in my story that by selling the truck, I can put that money into the laundromat, right? When I save $64 a month, what am I going to do with that $64 a month for the first 20 years? I'm not going to buy shoes or video games, that's for sure. I'm going to take that money and I'm going to put it towards my business or towards my investments. So I created one more tab in this spreadsheet. It's an annuity calculator, which is a calculation for how much money you'll make if you invest the same amount into some account that makes a constant compounded rate of growth. So here I've got $64 that I'm investing every month, 234 times, because that's the length of that solar loan originally. That's the amount of time that I'll be saving $64. My interest rate, I put at 3%. I think this is extremely modest, but it's better to be modest than to be too generous. And so the total amount that I will have saved and the total amount that I would have invested would be $14,000. That's 64 times 234. But the amazing thing is, the future value of that account is $20,000. So I've made like $5,000 investing at this rate. And as long as the amount that I make exceeds the extra cost that this loan is going to give me, $978, as long as I make, and I have 20 years to make it, using $64 a month in 20 years, if I can make $1,000, or more than $978, then this loan pays off. But it's contingent on how I use that $64. So, you gotta ask, did I make a good decision? I mean, it's kind of like the food truck, the restaurant, and the laundromat, right? It really depends on that money. Now, I'm telling you that I invested that money into the stock market and into my own business, but how are those performing? And are they performing very well? What if they don't? What if they fail? Like, I'm taking a risk with that money, right? Isn't it better that I just pay off the debt than take a risk with that money? Or is it? I'll tell you what. This much I can say. Handling debt and how I invest it is simply a risk I'm willing to take. In my situation, I am more than confident that $64 a month for 20 years is going to profit me more than $900. I'm going to make more than $1,000. I can do it in so many different ways. But I've been investing in the stock market for like 17 years, and my business is something that I'm watching grow, and I have reasons to think that I can pull this off. And for other people, that's not a route they want to take. Pay off the debt. I don't want to take any more risks, and that's fine. But, like I said at the very beginning, there are the Dave Ramseys and there are the Robert Kiyosakis. So, take what you've learned from this video If it makes sense, I hope this is a strategy that you can take advantage. And if I sound ridiculous, then cool. Like, you're a Dave Ramsey. That's awesome. Good for you. Own it. Okay. I really hope that you liked this video. I hope you got something out of it. If you did, I make videos every week, and topics about money and looking at spreadsheets tend to be what I'm pretty good at. So you can expect to see some more of that, and I hope to see you next time. Take care.